In light of recent market volatility, I thought we could start out with a quote from the famous Shelby Davis. You make most of your money during bear markets, you just don't know it yet. So John, times like these, it kind of feels as an investor that the markets are broken. It's easy to get in your own head about things and think, gosh, how am I ever going to make money? I'm looking at my statement, I'm looking at the MSNBC or Fox ticker symbols, and we're just seeing red all day long in the stock market. And you can tend to feel a little bit helpless as an investor. So during times like these, you hear us, we're always glass half full here because effectively markets do go up over time. All the historical research and data says that, but it's easy to get in your own head with the potential downfalls of investing and how painful it can be emotively, specifically. So we thought we'd pivot and talk a little bit about listening to some of the best investors of all time. And you had a nice quote, or actually poem, from Warren Buffett, if you wanted to read that.
Yeah. So Warren Buffett, during down markets, there's a poem called "If" from Rudyard Kipling. Here's an excerpt from the poem. If you can keep your head when all about you are losing theirs, if you can wait and not be tired by waiting, if you can think and not make your thoughts your aim, if you can trust yourself when all men doubt you, yours is the earth and everything that's in it.
So why don't you break that down from an investment standpoint? I think this has a lot of different implications. You can be pretty philosophical with it, but just from breaking it down from an investment standpoint, where how Warren Buffett uses that as his mantra, maybe get some thoughts on that.
Yeah, I think the first one is, you hear all this news from different organizations, one way or the other, and people are losing their minds. Well, when Buffett's coming back and saying, okay, what do I need to think? I need to think about what I know logically, as opposed to just hearing all the emotional biases out there. That's one thing that when you step back as an investor, making sure that you're looking at the underlying information rather than hearing opinions, that's what I believe.
Yeah. So it's so you're speaking effectively to the emotive standpoint. So really there's kind of two things that I think are going on here to kind of piggyback on that. Is one is our natural emotive response to down markets. It's good news doesn't sell. As we know, when we start talking about politics, we're going to stay away from that. Same thing goes for the markets or anything, right? I think that's what you're getting to. So you need to go almost a little bit more insular, and for folks to say, well, that's good, that's good and all. The emotive piece is not fun, but my statement's still going down, right? Yeah. The dollar value of what I own is still going down. I think that's where you have to get back to the logical standpoint of, the stock market. I think it bottomed out in the middle at the bottom of COVID at 2120, the S&P 500, mid-March sometime in there. Yep. And we're still hovering around the 4,000. We've been well above the 4,000 mark. A lot of economists are saying we're still going to be above the 4,000 mark at year end this year. So basically, that's 150% upside of what we experienced at the bottom of just COVID. Now we can extrapolate that out to 2008. We can extrapolate that out further. So the logical thing is markets go up over time. They're efficient. And it's highly emotive along the way. And that's effectively what you were getting at, I think, with that.
Taking it back to the Warren Buffett quote, if you can wait, waiting can be very difficult and very hard and very exhausting, emotionally and physically, when you see these markets instability and declining. To take it back to a quote, exhaustion is not an investment policy. And when you talk about waiting, just stand there and do nothing. Is something that you have to do, and just look back historically and say, hey, is my plan doing what it's supposed to do? Has it been stress tested during good times and bad times to say, am I still on track?
So the big takeaways from this is, first and foremost, create a plan and stress test that plan in the good markets, knowing that confidence that we see in the good markets should hopefully give us the mental and emotional fortitude to stick with it when we see times like actually today and this last week actually occurring. There's a lot of red on the screen, a lot of down stocks. Secondly, understanding that, hey, we're going to stress test these plans in the good times. So knowing that, hey, maybe you don't want to be loaded up on crypto. Maybe you don't want to be loaded up on tech stock. right tech stocks right now, or maybe you do, but right now is a prime example of why we look at asset allocation as part of your overall plan when times are good as well as when times are down and not so good like we're seeing right now. Yep. And third, we're not saying don't take advantage of down markets. We're not saying don't do anything, but what we are saying is don't sell out of your risky assets, so the ones that might be a little bit more volatile, that over the long run will actually give you the returns you need to feel like you need to feel safe, right? To quote Nick Murray again, exhaustion is not an investment policy statement. So we need to create the mental fortitude, and that's from the plan and the partnership that I think we can help provide our clients, and that should hopefully give us the long-term resolve to ride these types of markets out. Hope this helps.